So if you've been around this channel for a while, you know that I really like investing and that it has mattered to me and been important to my financial development for a long time. I started picking out my own stocks to buy very young. I was writing books on the stock market in middle school, and you may have seen videos on the channel like these. So what I want to do in this video is cover some basic investing mistakes. And I want to answer the question, as I'll touch on in a second, of how should you invest? Not through that lens, but through the inverse lens of how should you not invest. And I think some of the lessons there are even more valuable by far than those questions of how should you invest, because they help you limit your downside to not just lose all your money and have to restart or quit on that journey or those stages of investing for the first time. So I'll keep it quick. This whole video will be straight to the point. That said, let's get into number one. So we're obviously talking a lot about investing in this video, and the requisite step to investing is having some money to invest. And that brings me to the sponsor of today's video, Free Cash. Free Cash is an online platform where users from all over the world like you can sign up for free and earn money by playing all kinds of mobile games. You receive offers from games in the app and then complete those offers, and then you can withdraw the cash to PayPal through gift cards and through various other methods. Here's an offer for Rise of Kingdoms, which has over 100 million downloads that I claimed because I like strategy and strategy games. And to earn this money, I downloaded the app and started playing it like so. And it is important to enable in-game tracking so that Free Cash can reward you for your in-game progress. And these guys have over 4.5 stars on Trustpilot from over 160,000 reviews, so they are legit. And they make it easy to make some money doing what you probably already do otherwise, just play games in your spare time, like waiting for the stock market to open or sitting through those boring parts of an earnings call. Here's me with Rise of Kingdoms, and I did make a few in-app purchases that I got cash back for with the bonus rewards. And here is the cash out section where the funds you earn can be withdrawn to PayPal. And here's the last real cash out that I received in my PayPal account. So if you would like some extra money to invest, then by clicking the link in the description or this QR code, you can get a $5 bonus on the first offer you start in Free Cash. And note that the interface may look slightly different depending on the country you're in, but the functionality will remain the same. So again, that is a $5 bonus on your first offer, and just click that link in the description to get started. And that said, let's head back into a deep dive on navigating the minefield that is investing. Okay, now I want to start off this look at investing mistakes, not through the lens of how should you invest, but rather how should you not invest. This is a book called How to Stay in Love by a man named James Sexton. He is a famous divorce lawyer. And his lens on, well, how should you stay in love? How should you have a healthy, stable relationship and marriage isn't through the lens of what works, and rather, well, what doesn't work. And let's just avoid the things where it's really easy to go wrong. And if you do that, then maybe you arrive at this answer of, well, how do you have that positive thing? And so in this case, we're going to try and answer that question of how should you invest through the lens of how should you not invest. So that starts off with this idea, which is that everyone messes up, especially trading and investing professionals. And there is this illusion, maybe it's, big words or a lot of acronyms, maybe it's people in suits that cover up the difficulty of investing better than the quote unquote market. And a lot of the people who are professional investors, in fact, nearly all of them, are not actually as good, likely, as you think. And what that means is there is more to lose than there is to gain. I'll say that again. There is more to lose by investing wrong than there is to gain by learning about investing, by trading, technical analysis versus fundamental, by being more like the professionals, right? This image right here is a percentage of managed funds. So these are professional stock traders who manage these funds that people invest in for large companies who underperform the benchmark being the S&P 500. And the S&P 500, the Standard & Poor's, basically the market measuring stick. And it's just a lot of big companies, the top 500 companies in the entire stock market. And if you beat the market, Well, when you say you beat the market, you're talking about I beat the S&P. So if the S&P went up 10% and I made 12%, I beat the market. Well, just look at this right here, right? Over a 20-year period, 93% of professional traders actually do worse than the S&P 500, than just the market. Now, this is going to be slightly different depending on all, large cap funds, small cap, international, domestic, but these results generally hold. Whereas nearly everyone, nearly all professionals don't actually beat the market. And so what that means is, I just said this, but I'll just say it again to nail in the point. Even if you put in years of school and you're a professional and you research all your investments and make complex decisions, you're probably not going to do that much better than the market. But it is relatively easy to lose a lot of money. And so that's what we're avoiding through also how not to invest instead of, well, how do you invest? So everyone's going to make mistakes. Let's just try and limit the downside for you before or as they happen to you if you don't have a lengthy background in investing and some of the kind of calluses that come as a result of that. The next point I want to make, and this doesn't sound that important if you haven't been through it or you haven't invested, and then it starts to become a lot more important and you realize why it's so important as you or if you start consistently doing that. And what this comes down to is the fact that money is a supremely emotional thing. It's a liquid, a metric form of value in a sense, and we all care about money. We put a lot of effort into money. We don't want to lose money. And this is a proven psychological phenomenon that happens, whereas people really, really don't want to lose money. And so I'm not on a high horse here. I've been through this more times than I care to admit. But it doesn't feel good to lose money. And when you do lose money, you want to not lose more money. You want to make that back. And so what you get is this kind of optimism curve generally, and that applies to money as well. Whereas if you start something like investing, right, you have this uninformed optimism. You think, I can research all these stocks, I'll do more research than everyone else, I'll use AI, I'll do X, Y, and Z. It changes by the week, and I'll get an edge, and I'm going to beat the market and get so much money. And then some time goes on, maybe it works for a little bit, and then boom, something goes wrong, you lose all your money, you make a bad trade, and now you're down here in informed pessimism, right? You have that disappointment after those first losses. Well, if you keep learning, if you keep sticking with it, you do it for long enough, and your strategy is actually solid, or you change it so it becomes solid, then you get up to this informed optimism stage where you're making as much money as the market, you're beating the market slightly, and there are great people that beat the market year over year for decades on end. That's possible. But those people went through this, right? Uninformed optimism, informed pessimism, then up to informed optimism. Probably less optimism than previously, but some measure of optimism. So because money is so emotional, this just applies on steroids, and you will likely go through that phase of uninformed optimism. Oh my God, I can make so much money. I had a great trade. And then you're going to lose all of it. Something goes south. Oh, I'm so sad. A lot of people quit investing at that point. Some others don't. And then maybe long term, it works out and you settle on something stable. I'll give you a very material example to wrap this up. When I was in middle school, I started to learn about options. Options are like they're a derivative kind of bet you can make on stocks, where you're trading contracts, where the underlying asset is the stock. You can watch a video if you want to learn about them. Maybe you already do, but they're essentially just a riskier version of stocks, where you can win more money, but also you can lose more money. And I started placing big bets. Like I only had, $1,000 or a few $1,000s in my account at the time, or what I earned to put into investments. But I started, making 30% here or 100% there. I quadrupled that money in maybe a month or two. Let's say a month. I don't remember the exact volume of time. That was this uninformed optimism period where, frankly, I got lucky. The market was going up. I did, in fact, make some good bets, and I quadrupled my money. Great. Well, then I was so uninformed, I was so optimistic that I took all that money and I put it into Tesla stock before earnings, and I was betting on news. I was betting on earnings, and I was betting on news that was coming out. So that's basically the dumbest, the riskiest. I won't say dumbest. In some situations, it works out. It's incredibly risky, though. And so I taken literally my whole portfolio. I stuck it in this trade. It didn't work out in my direction, and I lost the entire portfolio. Went to zero. So then I got this informed pessimism, and I quit options, and I didn't start trading them for another 4 years. And then when I did get back into it, I started looking at covered bets, covered calls, covered puts, much kind of safer bets I can make to just kind of slightly accelerate returns over time. And that is kind of this informed optimism. That's just one case, but that applies to general trading as well. So just keep this in mind as you're going through those highs and lows and experiencing that intrinsic emotion of money. That said, probably the most common way not to invest is to not trade on news. This happens a lot, whether you hear it from friends, whether you hear it from associates, whether you hear it on social media, politicians, right, whoever it may be. The problem with this is that markets nearly always price in news. There's this notion in economics of the efficient market. There's the efficient market hypothesis, the EMH. And that's the idea that markets price everything in. That may not be exactly true, but it is true that they are pretty efficient. And by the time you hear about a rumor or news, it's probably being priced in. Even if you invest because of something happening 2 years in the future, right? Like Wynn Resorts right now, it's 2025. They're opening a location in Dubai in 2027. They're building this big property. That's going to make them a lot of money. And so maybe you think, well, no one's trading on it now, right? Well, the market probably has priced that in because they price everything in. That's like the theory of the market. And there's this whole slogan that's buy the rumor, and then when the news comes out, sell it. Generally, it doesn't work. Like if you try and do this more times than not, you will lose money, and it'll feel great on the times that you win because you beat the market, right? You made some money. But other than that, just if you avoid trading news, going back to there's more to lose than there is to gain, you're going to be better off. So there we go. That is that first investing mistake to avoid. Next are to overemphasize market crashes. And I think this is a really important chart. This is US stock market returns for that S&P index that I talked about previously over a period of roughly 150 years. And this is real returns, so adjusted for inflation and reinvested dividends, so like cash payments that are put back into stocks that you get from owning those stocks as well. And a lot of these, or at least what stands out to me looking at this, a lot of these years are red, and a lot of them are pretty big red. We have lots of 10%, some 20, some even 30% negative years. And I say this right here, 10% plus drops in the market happen pretty regularly. 20% plus drops also occur, 3 times a decade, 2 times a decade, relatively often. And so what that means is it should not feel like the end of the world, going back to the emotion of money and investing as well, if these things go down. Because that's the whole market going down 10, 20, 30% plus. Imagine individual stocks. Some stocks, recession proofers like J&J, may go up in those periods. Other stocks may go down 60%. And that could happen 1, 2, 3, 4 times per decade. And so historically, I won't say what you will about the future, but recovery historically has always followed these crashes. And that's why whether it's a big up year, whether it's a big down year, that should not feel like the end of the world in either direction. And that state is not likely to continue. If you had a big up year, it's not likely to be a big up year every year. If there's a big down year, it's not likely to be a big down year every year. And it does feel like that in the moment. It really, really does when the stock market crashes or when it has this best day and everyone's euphoric and you're making so much money. Those things are so, it's a numeric, it's a financial game, but they're also so emotional, and so much of it is about psychology in terms of how people, how consumers, even professional investors invest. They say time in the market wins out, so just stay in the market, stay stable, get to that point of informed relative optimism, and you'll be fine. Next, friends and family. This ties into trading on news. The big do not here is just do your own research, DYOR. It also ties back to what I said with, most professional investors don't actually beat the market, which basically means what they spend their whole life doing, they're not actually that good at, quote unquote. I'm not saying that about specific people. I'm just saying that about many hedge fund, many equity fund owners do not beat the market, and that's literally their whole job, to beat the market and to get stable returns. And those are professionals. So what about your friends? What about your parents? If you're talking about insider information, that's a whole different thing. That's illegal. I won't comment on what you should do if you get some inside information. But as far as people giving you advice about other companies, maybe they know what they're talking about, but chances are they don't. And no matter whether they do or they don't, just do your own research. Don't just accept what you're told and just go based off that. Do your own research, and that again limits the downside, even if you potentially could have had a winning bet by just accepting that person at face value. In a lot of cases, the bet that you don't do the research on, that's the one that goes down 60%. You get trapped in this cycle of, I don't want to sell to materialize losses, and it gets worse and it gets worse, and you lose all your money. So don't be this guy. Don't be the trust me bro source type of investor. So next is selling too early. This is a big thing where, let's say there's a great company. Let's say you invested in Amazon in 2006, and it goes up 20% over a period of 2 months. And you're like, hey, I made my 20%. 20% is great. And then you sell. Well, did you just sell? Let's say in 2006, you viewed Amazon as a fantastic company, well-run, great CEO, wide open market. Despite all of those fundamentals, you sold just because 20% is a big number. That happens a lot. Again, you don't want to lose. You want to materialize the just on-paper gains that you made. What I urge you to do, as far as the mistake goes, is consider the fundamentals. If the fundamentals back the decision to sell, then sell. But do not sell too early just because the gain is big, if that makes sense. You need to contextualize that gain in the context of the company. And so if you have confidence in the company long run, if you think the valuation, given the growth, like let's say the Ford earnings multiples, right, Ford PEs, just whatever metrics you go off of, if that's all solid, don't sell, even if you're up big. Just hold. It's a good company. Like, why would you sell? Maybe sell some of it to recoup what you put in, but don't just sell your whole position. That's this point. And the next one is, well, selling too late. You kind of have a similar problem with selling too late, but it works in the opposite direction. This right here, CGEI, is a company I invested in. And I made some money initially. Like, I was investing back down here. I tripled my money, and this is great. I'm up a few grand, however much it is. And then, I make a lot of money. I'm up like 400, 500%, and then it starts going down. And now I'm only up 150%. I'm only up 100%. I'm up 75%. And at every point as it's going down, I could have sold, but in my mind I was like, but I used to be up 150%. I can't sell now. It's going to go back up to 150%, even, and this is the critical part, as the fundamentals deteriorated, right? So same thing here. You sell too early while ignoring fundamentals. This is the opposite problem. You're still ignoring fundamentals, but it's not working out for you because you weren't selling, because you own a position where the fundamentals are really, really bad instead of selling out of a position where the fundamentals are really, really good. And so what ultimately happened is I came back down here and then zero. And then the investment quite literally went to zero. I could have sold at any point along here for a big profit as over a period of years, the fundamentals got worse, but I didn't. And this is really the sunk cost fallacy in action, where you hope that it's the best way to describe it. Losing positions are going to come back to their former glory without the fundamentals indicating that as well. Even worse than this in how not to invest is doubling down. And that's that poker logic or the blackjack logic of eventually I'm going to win, or eventually this is going to go back up. So if I just double my bet every so often, I'm always going to break even. I'm always going to make money. The silver lining that I mentioned here is just if you lose money on taxes, then that is deductible and you save a little bit of money on taxes. That is not a reason, absolutely, to lose money. So don't double down. Do not sell too late. Go off the fundamentals first and make decisions either to keep holding or to sell based on those things. Okay, next up is IPO traps, and this was a big one, like 2020 to 2023, I think, less so in the last year or two, just because there have been actually very few IPOs. But there's this notion that you're getting in early for an IPO, and that like you're special if you can get in early on an IPO, kind of in the way we described previously for rumors and trading on news. The raw numbers tell us that most IPOs underperform the market in their first few years. And what that means is if you trade just 10 IPOs in a row, you're going to lose money if you invest early or in the actual IPO of those 10 companies net. But then there's still this romantic notion that people cling to of, well, this company there's so much hype around it, it's gonna blow up. And so you have a lot of people investing in IPOs. So if you're new to investing, don't invest like this. The investing mistake is just period to invest in IPOs. Just don't for your first year or two. Maybe put a little money in after they come out, after they have a few quarters of performance, and feel those things out. And then if you'd like to start investing really early. And I say this distinction here as well, right? Most of the IPOs you hear about are going to beat the market, but you don't ever hear about all the ones that don't. Rivian is a very good example. A friend of mine actually invested in this and actually made some really good money. The stock popped on like the first few days. They sold at a 60% profit in 2 days or something like that. And good, they got out. They got really, really lucky, because then look what just happened to the stock over a period of 4 years. And that is just what happens like more often than you'd think. So I'm going to wrap this up with Wall Street Bets. Now, I love Wall Street Bets. It's a community of like degenerate traders that get really, really rich and more often than not get really, really poor as well. And I urge you to spend some time just scrolling through Wall Street Bets, and it's people putting incredible amounts of money on the line, often with risky, option strategies and whatnot. Again, the culture, I love it so much. It's really fun, and you can learn some things as well. You can, especially in some advanced options strategies. Again, which I do not recommend, speaking from experience. And I think that the real lesson here is that this Wall Street Bets is a masterclass in how not to invest. And going back all the way through this presentation, Wall Street Bets is a masterclass in you have a lot more to lose than you have to gain by investing wrong. And it's full of people who invested wrong and who lose all their money, all their savings, their parents' life savings, etc., because of investing wrong. And yes, you can win big. But for nearly everyone who is successful long run, they make it to this informed optimism stage, and then they just accept that over the long run, you're going to make money. So, go look through Wall Street Bets, have some fun. And And I hope that this has been helpful in how not to invest. I'm not telling you how to invest. I'm just saying don't do all the things that we just talked about. And then you can see a video that I'll put on the screen right here, which is a full debrief on the actual stock market and investing. You merge those two things, you will be pretty good to go. So now that you have learned about all these different traps to avoid while investing in the stock market, that gives you all the more reason to start investing and set yourself up for long-term financial success. That also gives you all the more reason to head to that link in the description or this QR code to claim that $5 bonus on your first offer with free cash. And again, the central message of this video is just start investing and avoid these things. And if you avoid the things we've talked about, I'm very confident you'll make it, you'll be fine. Worst case, you perform like the market does. Best case, you beat the market if you don't do these things. That's my hope for you. Leave any comments in the description, and we are looking to hit 1 million subscribers this year, so I hope you join the community. And that said, I'll see you in the next one.